Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Daniel Roberts. He's the co-founder and co-CEO of IREN to the channel. They just came out with their full year and Q4 earnings, but there's so much more we want to unpack in today's discussion. Now, before we get into that, please take a second, smash the like button, you guys. It's a big help to myself and the channel. Anthony loves it. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below if you're currently holding shares of IREN, how you feel about their construction updates coming out of Childress, and your outlook in terms of HPC and AI for this organization. Now, with that being said, let's get into today's video. Okay guys, so that's right. Today's video, we've got the privilege of having Daniel Roberts back in the studio. He's the co-founder and co-CEO of IREN. There's been so much going on at this organization, Dan. I know you guys just came out with your full year results. You also included Q4. I just saw you on CNBC as well. Really a great success story for IREN this year, going strength to strength. And we want to talk through some of those points in today's video. So greatly appreciate your time and thanks so much for being here today.
Thanks, Bryce. Pleasure to be here.
You're always welcome, my friend. Now, I know it's been a few months since our last visit, so I wanted to maybe kick off with earnings, maybe get some of the highlights there. This was a very well-received earnings, despite some of the challenges in Q2. I know the retail community and investment community was very happy with the numbers and the progress they saw. So can you walk us through some of the highlights in your opinion there, Dan?
Yeah, sure thing. And I think the main highlight comes from the fact that we have built a long-term business. So we're not solving things on the fly. We've put down the building blocks over the past 6 years, knowing that these moments come where there's huge amounts of appetite for power, land, data center capacity. So putting those building blocks in place around securing the land, securing the grid connections, building up large teams from the construction and the development side and being able to execute when the market turns favorable. And we've seen periods where it's not favorable, but being ready to capitalize on those moments is something that we focused on from day one. And yes, we're seeing a period in which we can do that. And I think during 2023, we grew our mining capacity from 1.7 exahash up to about 5.6. We're on track to take that 5.6 exahash up to 30 in the next 115 days, just looking at the calendar. So it's been an enormous execution success over the last little period. And I guess for us, we're seeing the fruits of that come through in our operating cash flow, adjusted EBITDA number north of $50 million for the year. And really, it's about now forward planning for 2025 and beyond.
Great, Dan. I appreciate you sharing those numbers. Obviously, a lot of positives in the earnings. Now, one thing that the retail community has definitely latched onto on X is some of the hedging strategies that were used over the summer months here. So next up in the conversation, I'm curious if you can walk us through just kind of the process and the situation in relation to the hedge strategy.
Yeah, sure thing. So I think if you look at the history of the hedge strategy, really, to be frank, it was a choice of operating under a hedge or not operating at all, i.e. the facility's on or it's off. And the reality to that is the history of Bitcoin miners in Texas and the exposures that this sector and these companies can create if they're unable to successfully curtail when power prices hit $5,000 a megawatt hour. So you've seen through history that retailers and companies have built up quite a large exposure. It's made the retailers nervous about providing that spot exposure. It doesn't mean it's impossible, but particularly given the early stage of our operations in Texas, the relatively small amount of megawatts operating until recently, combined with the fact that we've been building up this track record of our systems, demonstrating the multiple levels of redundancy in it. When July came around, it almost came at a perfect time in the sense that we saw the hedge go wrong. We saw the fact that we locked in a forward price, and a forward price is always a point in time expectation of future market prices and the future distribution of market prices. When that forecast doesn't eventuate, you can end up on the right side, you can end up on the wrong side. And I know it sounds like 101, and that's where it went wrong. So we sat down with the retailer and just said, guys, this is silly. Like, it's time for a change. We have successfully shown you that our systems are immensely robust. Look at the track record. Look at the multiple layers of redundancy we've got in terms of our software and physical ability to curtail. We've got to change this because this is what goes wrong when you've got a hedge in place. So now we've successfully navigated to spot. And what that means is every 15 minutes, our systems are automatically looking at the ERCOT wholesale market in terms of power prices. To the extent that power prices are looking higher than what we would otherwise like, then those systems automatically curtail, put the computers to sleep, and we do not operate during those high price power periods. So what that means is your basis risk, your market risk is alleviated when you compare it to the hedge situation, and we're able to really optimize those power prices looking forward.
Yeah. And obviously, you know, that's obviously a lesson learned now, and we'll see the benefit of moving to the spot price now as we go forward with future updates. I mean, one thing that will alleviate some of that issue is the fact that you announced very recently that you got to your 15 exahash and you'd reduced or improved your efficiency, the fleet efficiency, down to 19, something like about a 20% reduction on the previous efficiency. So in terms of where you are now, and I'm assuming on target for September to get down to 17 joules a terahash, and then by the end of the year we're at 15. Can you sort of like give the listeners an understanding of what that physically means in terms of power costs? Because if you've got more efficient miners, where does that tend to put you in terms of your energy?
Yeah, so part of it depends on our curtailment preferences at Childress, because we can set the parameters. And this goes to a lot of downside protection in the business model, because if Bitcoin fell or global network difficulty increased and Bitcoin mining profitability deteriorated from current levels, then we can just reduce the price parameter level at which we sell power, or rather we don't sell power anymore, we just avoid taking the high price power, and we can lower our cost of Bitcoin mined. So if you look at history and look at some of the data, so over the last 5 years, if you curtailed every time the market price of power hit, say $100 per megawatt hour, you'd be looking at an average power price of about $24. If Bitcoin's running, profitability is higher, and you only curtailed at $150, then you'd be operating at about $27 power price. Under the latter scenario, you'd have about 4% downtime. Under the former scenario, you'd have about 6% downtime. So that just highlights the dynamic nature of the ability to trade this power or trade around this power with our Bitcoin profitability, where we can look at lifetime market power prices on the power, lifetime market profitability on Bitcoin, and have the option but not the obligation now under a spot arrangement to take power when it's profitable. To answer your question more specifically, our Childress August month to date electricity cost at the time of the earnings announcement was around 3.1 cents per kilowatt hour. Based on current difficulty levels, that's around $23,000 per Bitcoin in terms of electricity costs. So how that plays out in the future, historically, if you went back to the inception of our Childress facility and said, let's look at what our power price would have been with no hedges, but the same operating, same curtailment price profile, you're looking at about 3.5 cents a kilowatt hour. So to your point, as efficiency starts improving on the trajectory that we're on over the next few months, that will obviously help things, and then that will somewhat be mitigated depending on global network difficulty.
Yeah. Does it surprise? I mean, we've just seen a couple of miners produce their updates today. So Bitfarms normally the first out the gate, get their update out on day one. And it's noticeable because they're the benchmark every month now in terms of what we expect from every other miner. Is obviously production was down again in August for the same number of days as July. And we're not seeing any sort of like, obviously the difficulty is increasing, so that's impacting your production. The Bitcoin price has dropped from 64 to 59,000 in a month, which means the revenues are also affected. I mean, was there an expectation in your eyes that you may have seen maybe more coming off more machines coming off the global hash rate with the sort of like the margin at the moment? I mean, I know you guys with what you're doing at the moment are doing something exceptional in terms of the prices that you're paying going forward from here. But not every miner's like IREN or some of the other players like you in the market. That's I'm finding it hard to understand myself, really, Dan.
Yeah, I mean, even if you don't have our flexibility and low cost power, it's still pretty profitable, right? Like you look at that 17 joules average and $23,000 per cost per Bitcoin mined. Like even if you're operating on a 100% power price premium, you're still making a reasonable margin as compared to spot. And remember, people are investing on forward expectations of where Bitcoin might be, the embedded optionality of an exponential digital asset being bootstrapped. So it's not hugely surprising. Capital is really hard to come by if you're not one of the larger listed players, as we know. And the other thing that isn't often spoken about, which I think is real, and we talk about it every single year around this time, is you get this summer effect in the Northern Hemisphere where a lot of these facilities can't cope with the heat. So you get this temporary lull in the hash rate across the hot summer months relative to where you would otherwise expect. And then everyone sees a rebound as the weather starts to cool off slightly because, oh, where's all this extra hash rate coming online? And very simply, it's just existing facilities now being able to operate in the temperature.
Yeah, good point.
Fair enough. Extremely impressive numbers when you talk about your cost to mine a Bitcoin there, Dan. And another impressive component of this organization you just referred to is the Childress asset or property. We continue to see more and more photos. The construction progress is coming along at a great clip or pace there. We wanted to see if you could give us a quick update there, how you're feeling about the site, and any potential learnings. Anthony and I have really been beating the drum about the single site advantage here for yourself and Riot. The fact that you guys have everything in one location, you're able to rinse and repeat and learn as the process goes. Are you able to share any of the benefits you've seen firsthand from that?
Yeah, sure. I mean, we're learning every day, Bryce. We're far from perfect, make lots of mistakes, but it's how you respond to that and the next decision that you make. And we've seen that at Childress. We see it everywhere. We had challenges earlier on with labour at Childress and just sourcing the right type of people. It's not a major hub for data centres, as we'd all be very well aware. So we've had to build that from the ground up, and it takes time, and it will take time at our next site, and we're already thinking about that. So building up the right type of labour force with the right values, the right culture, being very robust and firm and assertive around our principles when it comes to safety and expectations has been something that we've been really firm on, and it is paying dividends. We look at the cadence of this data center build out, we look at our safety record, we look at the quality coming through, and absolutely it's paying dividends at the moment as we continue to build out these data centers. So I think one of the big learnings is do not rush early on. Take your time, get things right, because like everything, if you put the investment in early and you take that extra little bit of time to do it right the first time, and that goes to every decision around where you do the civils, don't cut a corner, where you do the foundations, how you procure, the people that you employ, the project management philosophy that you've got in place, you see that it pays you back, in multiples as time goes on, and we're seeing the benefits of that now. So there's some great learnings around that we can transport to our next 1400 megawatt site. That's probably around the execution specifically. And then in terms of the data center design, every data center we build, we are seeing the opportunity to optimize and do things a little bit differently. The upgrade from the 20 megawatts to the 25 megawatts, the opportunity to prefabricate some of the internal components so that they're delivered on site in a more advanced form to install rather than having to do various pieces of assembly on site. So lots of little things like that. I think we've got about 360 people on site at the moment. So it's not a small workforce. The team are doing a sensational job. It's a great group of people. And I know I sound like a bit like a broken record at times, but we're on track and we'll continue to execute.
Yeah, and it has been an impressive year for you from the growth of that hash rate. I mean, when you came out with that update about increasing from, I mean, me and Bryce were struggling to see if you would get to the 20 by the end of the year. And you came out and updated it and said, "Oh, no, we'll do 30 by the end of the year." I think not many people are going to bet against achieving that now. That takes you sort of like nearly half of the power at Childress. I know you just upgraded and increased the power size there. So there's another 400 megawatts that can be utilized, obviously going through from 2025. So it looks like 2025 focus on utilizing everything at Childress. Do you have is there an opportunity to utilize that? Could you have HPC and Bitcoin mining at the same site, or is the rest of Childress fully focused on driving to your next target in terms of Bitcoin mining growth?
Yeah, absolutely. We can have them both at the same site. We're doing that right now at Prince George in British Columbia. We've got racks of Bitcoin mining ASICs sitting next to racks of NVIDIA latest generation H100s, training AI cloud models. So absolutely, we can do that. We're testing our AI cloud with NVIDIA chips at Childress at the moment. So that's really exciting. So looking at how the different weather, the different environment impacts performance of those chips. We're cautiously optimistic based on the data and extrapolating it out from our experience in Canada. But you've got to try and then you find out. In parallel, we are looking and building our own designs around data centers that will have the ability to provide liquid cooling, whether that's retrofitting our existing building design, whether it's building from scratch, the ability to introduce some level of power redundancy for the compute halls as well. You might recall that all our critical IT infrastructure, that is designed already on tier 4 design principles. So network storage, communications, key management systems, etc. So backup generation, backup chillers, etc., and cooling. So it's really about what does that site look like in terms of what does the market want. And we're having conversations with potential partners for some of that capacity for HPC and AI applications. But equally, what we can control and what's in our hands is to continue building out our own data center design and utilizing Bitcoin mining ASICs to generate an instant return from those facilities. So that's got to be the base case because you can only control what you can control. So the base case is we'll fill up that 400 megawatts at Childress with Bitcoin mining as and when progress occurs around HPC and customers come to the table and we're able to secure that, then we'll just pivot at that point and build out something different. But that's the state of play, and we've just got to remain flexible, nimble, and dynamic around what the market wants.
And that's the key point. It's flexibility to move in the right direction. With regard, you mentioned there liquid cooling, and I know we had conversations on previous podcasts about would you go down the route of immersion cooling with Bitcoin mining, and you weren't sort of like fully getting the immersion cooling and how much capital's involved in doing this. Are you suggesting liquid cooling for HPC data centers, or would you be thinking along the lines of actually for both services?
Yeah, so I think there's a difference between immersion cooling and liquid cooling. So immersion is where you dunk these chips in dielectric fluid. I still really struggle to see the benefits of that. And I think the data is now becoming apparent, or the lack of data is becoming apparent as to the drawbacks of that. And I don't know if you can actually upgrade those chips very easily either, and because you're dealing with things that are stuck in the fluid. So I still struggle to do that, particularly with the rack density we're achieving with air-cooled, around that 70 kilowatt plus rack density. Now, remember, this comes back to air versus liquid. Why would you use one versus the other? And I will stand by the statement that air is more efficient than liquid at moving heat, because with liquid, you still have to cool down that liquid. You can't just release that liquid into the environment and say, goodbye heat molecule, never to be seen again. With air, you can. The air comes in, sweeps up the heat off the chips, evacuates that into the atmosphere, goodbye heat. So the advantage of liquid comes down to density. It is a more dense matter for storing heat molecules. So per square inch of matter, air versus liquid can retain more heat. So you go, okay, now I'm starting to understand why people might use liquid. If I'm in a legacy data center that's 5 stories high and I don't have the ability to move vast amounts of air through that facility to evacuate the heat, then yes, it kind of makes sense to use liquid, extract some of that heat, move the liquid outside and deal with the heat problem there, because I can't physically deal with it inside. Now, if you extrapolate that out and start forecasting future rack densities, and say, yes, there is going to be an upper limit to what makes sense with air cooling within the confines of a 6-foot standard rack space. So right now we're operating at 70 kilowatts. NVIDIA chips, the reference architecture at the moment for the H100s is 40 to 45 kilowatts. There is a lot of talk about that going multiples higher. Notwithstanding that, chips aren't at the moment, the latest generation NVIDIA chips aren't necessarily going higher than that 40, 45, but everyone keeps talking about the benefits of it going higher. If you want to go it higher, then a combination of air cooling and liquid will allow you to get that rack density well north of the 70 kilowatt and into the hundreds.
Now, Dan, in terms of HPC, I want to talk about your next upcoming project and site in a second here. But in terms of the HPC strategy, clients, I know poolside, the contract, I guess, ended at the end of last month there. So we just wanted to get an update on the types of conversations you're having. The nice thing you say is you've got the flexibility to really build out for whatever the client needs. Can you talk to us about kind of the model you're looking for, the type of customers you're discussing with, obviously the hyperscaler component of this discussion, and anything you're able to share there?
Yeah, sure. So, I mean, the poolside, they've extended the contract a couple of times and all good things come to an end. Would love to retain them as a client, but they've moved on to a much larger cluster where there's clearly a strategic benefit and angle for them. So that's cool. We may see them again in the future. We may not, but their customer references, referrals and testimonials are a fantastic sales tool for us. So we're really grateful to them for that. The silver lining with all of this is we're now out in the market offering instantly available GPUs as a cloud, and that's not necessarily easy to come by. So all of a sudden, we're having great conversations with a myriad of different options, many of whom need far more capacity than what the poolside capacity is today. So the opportunity to almost offer a part of those as a test and say, look at our facilities, look at our service, come and validate the performance for yourself as a gateway to hopefully bigger and better things is exciting. Equally, there are a number of parties that are interested in taking small amounts of capacity. And my expectation is that we will place that capacity in the future. And ideally, we'll be looking at ordering more. But the incremental decision to buy more chips is really about the risk return of each customer contract, because these are quite capital dense in terms of the requirement from capital. And you've just got to make sure you remain disciplined around allocating capital to those GPUs. What's the creditworthiness of the customer, the level of prepayments, the term of the contract, payback period, et cetera, because yes, these chips sound great. You're buying them on 24-ish month payback, but it's an uncertain world. What does the future of AI scale-ups look like? What does the future of the next generation NVIDIA chip or other chips coming out look like that will erode profitability of your incumbent chips? So there is risk around it, and we've just got to make sure we get that balance right.
In terms of, I mean, your strategy in HPC is obviously different from the one that Core Scientific have adopted in terms of getting, a big client to effectively, help them fund the refurbishment of their data centers to fit HPC hosting in there, and then basically just take away all the risk to Core Scientific. The energy contract is dealt with by CoreWeave. The GPUs are dealt with by CoreWeave. So, I mean, when that contract was announced to the market, I mean, it must have opened everybody's eyes up in terms of potential. Could we be a similar position? Is it something that you're interested in delivering on your other site there, the 1400 megawatt site? Them sort of conversations that way. We've only seen that one big contract. Is your expectation with the phone calls you've been having, not necessarily IREN, but do you expect, another miner to soon say, actually, we're coming out with an announcement imminently, or is the Core Scientific too good to be true? It was a one-off, and we're all fighting for the crumbs afterwards.
Yeah, the short answer is I don't know, Anthony. We're finding out, and this was part of engaging Morgan Stanley, right? There's very few organizations in the world that have the level of access Morgan Stanley has into these big end customers. So we're in the middle of that process at the moment, signing NDAs, sharing data rooms and information memos. So it's hard to preempt the outcome of that. Is there real appetite for capacity, and people are going to pay lots to get access to either retrofitting our existing design or building new facilities, leveraging the power of land? No idea. I mean, that's predicting the future. But would we have seen the type of companies signing NDAs with little IREN 12 months ago if this wasn't the data? So there are some little validation points along the way where you're having conversations with senior people at these organizations that 6 months ago you just would not have expected. So all we can do is continue to have those conversations, enjoy the interaction. And Morgan Stanley's appointment was principally in relation to the 1400 megawatt site and monetizing that by way of a large HPC AI campus. But naturally, when you get on the phone with these companies, they ask a little bit more about your business. They learn that you've got existing power and data centers at Childress and BC, the ability to offer an AI cloud service. So the conversation naturally wanders that way with certain players as to what the options might be. We've just come out of a bit of a lull in terms of the summer period and people on holidays. So we're expecting a bit of momentum to start picking up over the next few weeks to a couple of months.
In terms of the conversations you're having with your own analysts, so that the New York analysts and likes of Macquarie as well, what are their conversations are geared to it around the business? Are they still focusing on HPC, or is Bitcoin mining still irrelevant in their conversations with you guys?
Oh, they're interested in both. Absolutely. Bitcoin's the lifeblood of the business today, and punching out the cash flow and the going concern. And clearly, when you've got the ability to control that internally, where we've got all the power, we've got the land, we've got the internal team, we don't need to rely on M&A, we don't need to rely on things outside of our control. They're clearly very, very interested in that. And I think to your earlier point, they're starting to see that when we tell a target to the market, it's a target that we believe very strongly that we'll hit, and we haven't missed one yet. And that's a track record we're very proud of. So there's a lot of focus on that, and starting to look into 2025, triangulate numbers around our internal targets of 50 megawatts a month in new data center capacity, work out what that would mean in terms of chip efficiency and our trajectory. So all of those are options that we've got and can control. And then on the HPC AI side of things, it's the same conversation we're having with you guys. Like, at the end of the day, Will and I are very large shareholders. We're here to make money. We're here to make our shareholders money. And if there's a higher, better use for this power and land that's going to benefit the business, then we are all in. And, engaging people like Morgan Stanley and getting access to those really senior people and cutting through a lot of the middle management that you might otherwise experience at some of these big end customers. If we can be doing more, then I'm all ears, genuinely.
Anthony, anything else left on your list over there?
Yeah, I've got quite a few actually. So in terms, yeah, I mean, obviously going through the presentation in terms of 2024, we can see that you're fully funded to get to where you need to be this year. 2025. Do you have an idea at the moment what you're going to require funding to get to your target in 2025? What you have on paper at the moment? I'm not trying to get you to suggest what might happen, but what you know at the moment is your plan. All things can change in the future, but your plan at the moment, do you know roughly what you'll need to fund that plan and sort of like how we're going to get to that position?
Yeah, we do. So every 10 exahash is about $300 million of capex, all in. And that number has stayed constant despite us getting the more efficient hardware because we found cost savings in our data center design. So you might recall from our earnings call, we've been achieving $650,000 a megawatt for our data center capex as compared to historical guidance of 750. So that's allowing us to pay a bit extra for better chips and still fall within that $30 million of capex per 1 exahash of capacity. So look, if we're looking to go to 50 exahash next year, then that's $600 million of capex. Sounds like a big number, but I mean, 2025, the end of that is 15 months away. It's a long time. The market can change a lot. So like always, we look at incremental investment decisions today, tomorrow. What is the marginal decision that is required now? And preserving all the optionality to grow faster, grow slower, not grow at all, depending on market conditions. And the decision right now is around the infrastructure. So how do we get prepared to build out all the data center capacity? The chip purchase and the options we have over that is a future decision. Don't even worry about that. We've locked it away. We've got the call option on the chips. If Bitcoin goes silly and runs really quickly, then we have locked in our maximum purchase price. Happy days. So what's the decision today? Well, civil work, basic design and planning, ground clearing. So that's the decision. Yeah, it's a no-brainer. Do we start building out the first few data centers? Well, at $650,000 a megawatt, $13 million, the $13 million for the old 20 megawatt data center, you probably do start building those out and preserving the optionality. So it's all piecemeal, it's all incremental. And that's the only way you can play it in this sector because you are dealing with an exponential volatile end commodity, and being able to be flexible and nimble around these decisions is what allows you to survive when times are tough and then thrive when the market turns.
Does it generally become slightly more cost effective because if you're going to expand on one site, the sort of like obviously there's less of a design issue because you've designed these data centers, these 20 megawatt data centers. The fact is you're going to build more of them. So actually, does it actually bring cost down a little bit? I'm not saying it's going to, but a little bit in the fact that you don't have as much design element in those costs that you had in your initial 5 buildings, for instance.
Oh, absolutely. The economies of scale are clearly coming through. And that goes to multiple things. It goes to amortizing corporate overheads. It goes to the efficiency of the design process. It goes to the efficiency of the construction process on multiple levels, i.e. you've got the same construction teams just rolling from one data center to the next data center to the next data center. So that ability to not incur mobilization, demobilization expenses with a large scale workforce and just continue them rolling through building it out. It's almost like they're operating a business, but their operations is just continuous construction. So the benefits of that are absolutely apparent. And if you've got smaller sites of 50, 100, 200 megawatts, then you just can't see that because the time it takes you to build up a workforce, build up the size, and speed of execution safely and in the quality environment, you just can't do it. So the benefit of having 750 megawatts at that one site, the benefit of then rolling into a 1,400 megawatt site, and we're not happy. We're not sitting here complacent with 50 megawatts a month. Why can't we do more? If not, why not? Everything comes back to first principles. What is the choke point? What do we need to do better? How do we grow faster? How do we improve the design and operations of these data centers even more? So, like I said earlier, we make mistakes. We're far from perfect, but it's recognizing that and that seeking continuous improvement as an organization, which I think we've done pretty well to date, and we can't lose into the future.
Couple of more quick questions for you, Dan, before we wrap up. And we've asked this to many of the CEOs actually about share-based payments, compensation payments. I remember a couple of years ago, you guys saying that you'd have to, the share price have to be astronomically get to a really high position before you started getting part of your compensation package for that. And I'm trying to think it was like $300, maybe $375 or something like that was a figure. Now I'm assuming as you sort of like increase the number of shares via dilution, does that impact the price in that sort of original guide? For points of word like.
Yeah, so the $75 strike price. So we've got options to acquire 2.4 million shares each at a $75 strike price. That strike price does not change based on the shares on issue. I think some of the vesting thresholds do, and they were the ones that went from that $375 up to $1,500.
That's right. Yeah, it was high. I remember it was high numbers. Yeah.
Yeah. So that's.
But it's when you only had like 25 million shares. I mean, you've got like 189 million shares now. The last time I looked, and so it's like I was in my own head. I'm trying to think. If you got to whatever one of those numbers, and you got 100, the value of the company would probably be close to what Tesla is or something like that in terms of where it'd need to be if the share price was like that. It's, it'd be, 100 times where it is today sort of thing, like, so it's just in my own head, I was just trying to get an understanding of did it impact? And we're not here to say CEOs, not deserving of stock compensation. I mean, it's a great tool to make sure everyone's, goals are in line with what the company's goals are, and hopefully, at the same time, the shareholders benefit in the increase in share price, as well as management and employees benefit from receiving compensation through that model. So we're not here we're just trying to understand the slight differences, company by company, because end of the day, Dan, it's still a fairly new industry. I mean, you guys IPO'd in sort of late 2021. The oldest public miner out there is Hive with not even 7 years old yet. I think it turns 7 maybe at the end of this month, something like that. So it's still effectively from a public company point of view, still quite a new industry. And so I know that some of the comments that come through social media about, levels of stock compensation, it's a question that we ask to make sure that, we're asking, we're not asking, what your favorite drink is or what you had for breakfast yesterday. We're trying to ask you a few more of the challenging questions that the retail investors and the followers want sort of the answer to. But no, thanks for that.
No, so maybe just a couple of comments on that, Anthony, because it is absolutely important. So first of all, I think we had about 50 million shares on issue in 2021 when we IPO'd. We've now got 189 million, as you say, but we're fully funded to 30 exahash.
Yeah.
So the shares we've issued have gone into CapEx that is now generating significant return. And if we never raised a single dollar of capital, then there'd still be 2 shares on issue, one to me, one to Will, and we'd have no business and no one would have the opportunity to invest. So issuing capital is something that we'll continue to do when we can invest every $30 million we raise in a new exahash of incremental capacity. You look at the market metrics and how they're valuing an exahash, particularly with our cost of production, you say, well, that kind of makes sense. Now, the second part of it is, well, stock compensation. I mean, clearly we're not here to work for free, and no one expects that, but we need to make sure that our fortunes are aligned more than our material shareholding to that of investors. So the $75 strike price options, that $75 does not change based on shares on issue. So we only see $1 of that the moment the share price hits $76. That's pretty good, I would have thought, if you're a shareholder. Then if we look at, well, what are the decisions we're making today as a business to make sure that we're aligned? And in our 20F that was released a few days ago, Will and I received roughly 1.3 million of RSUs. Of that, 1 million of them are at risk, where we only see one RSU, the first RSU, if we hit a $20 share price, and we only get all of them if we hit a $50 share price, all in the next 3 years. So again, 1 million out of a 1.3 million RSU package for this year, we are placing at risk at a share price that is at least 3 times where it is today.
Yeah, no, that's a good point. Yeah,
you know what? When we get to $76, I'll be a happy camper here, Dan, as well. So the $75 strike price works for me as an investor in this company.
Just a final one from me is this year we've seen a lot of M&A activity, more so than in previous years, and more so than 2022, when a lot of players were thinking there would be a lot more M&A activity during that downside in the Bitcoin price. But we've seen the likes of Block being bought out by Riot. We've seen Grid being bought out by CleanSpark. We've seen Stronghold Mining going through a deal now with Bitfarms. We've also got Riot looking at Bitfarms as well. I mean, are you as a company keeping an eye on what's going out there, with opportunities becoming available? I mean, we talked earlier about the challenges now for maybe smaller miners. There's a case of in the number of miners I cover, there's those that can grow and those that are going to have trouble growing, in terms of raising capital. You guys have managed to find that sort of formula in the way that CleanSpark found it. And managed to get their hash rate going, really well using the ATM, but it's not available for every miner at the moment. So in terms of raising that level of capital, they can go to the market and dilute. And if you go and dilute the market will penalise you on that day of the dilution, but with to give you a share price downgrade on the percentage that you're diluting. With the ATM, it's slightly different because nobody knows when you're physically selling the shares until we get your quarterly update, and everyone's then looking at page 1 and page 6 or whatever it is to find out how many shares have physically been sold in that last 3 or 4 month period. But from an M&A point of view, are you keeping an eye on what's going out there, or do you think actually we've got enough to focus on trying to deliver what we're going to do? Or do you think actually this business is going to start becoming less but bigger players in the market? I'm talking, say, next 3 or 4 years. Where do you see the Bitcoin mining industry in that point in time?
Yeah, there's a bit in there. So I think from our perspective, when you can build every incremental exahash in your facilities under your control for $30 million, it's pretty hard to justify M&A. I don't know what sort of facilities and businesses you're going to buy for $30 million in exahash, and have to be substantially lower to justify us doing that. But not everyone's in the same position. And as you alluded to, there are the haves and have-nots in this industry. And that goes to a few elements. Access to capital. There aren't a huge variety of players that have access to capital in this industry anymore. Unless you're one of the larger listed miners, it is really tough. So that creates, I guess, opportunity for large listed miners. And it also means that some of the smaller guys are finding it really tough. You then look at the variety of businesses out there, and not everyone has an abundance of power and land and the ability to build facilities and grow organically. So some businesses are going to be reliant on M&A. Some businesses can't execute. They might have land and power, but they can't build. So they'll look at M&A potentially as a way to get through that. So I think you will continue to see it. But is it easy to see us doing it? Not really. Never say never, but when you look at it rationally through the lens of what we can do without M&A and what M&A would do in terms of accretion to our business, it's really hard to see. And you've got to remember that M&A is hard. Like, yes, everyone talks about synergies and benefits, etc., but you inherit sites, you inherit people. Often they're not mega sites. Like there's so much headache involved, and it kind of goes hand in hand with operating a distributed network of smaller projects. There's always smaller headaches to deal with, and that takes up management time and it compounds over time. So for us, it was always focused on the mega sites, build at scale, do it cleanly, do it our way, do it all under our control. Because again, I think you'll see the benefits of that coming over the coming years in terms of operational performance and our ability to keep growing because we've got those large, solid foundations in place.
Yeah, you're one of 2 or 3 miners that have got the sort of the runway of power and potential to build with what you've got at the moment. You're not looking for new sites in the way that some of the other big miners are still looking for sites to sort of, to get their hash rate targets for this year, never mind what they're going to do next year. So you're in a pretty good position. And I agree in your analysis there about if you can deliver for 30 million per exahash, why would you be interested in paying, close to 100 million? And I think that when Riot sort of went out for the offer the Bitfarms deal initially at that share price, people were saying it's too low, but actually, if you look at how much it was for each exahash, it was quite a high fee. Compared to some of the smaller ones, we saw the Stronghold one go through a little bit lower than that in terms of value per exahash there, what they were delivering. But you're right, even that deal was nowhere near at 30 million exahash. So I can see why you're focused on just delivering your own. And plus, the quality of sites differs from site to operator as well. So, we've been fortunate, Bryce, myself, we actually managed to get to a couple of sites this year just to see firsthand what this Bitcoin mining thing was all about. And we talked about it for 3 or 4 years. Now we actually finally got to see one. And I'm sure we'll get an opportunity to come and see you guys either in British Columbia or at the Childress site in the not too distant future as well. But thanks for today.
Anytime. Thanks, gents.
Yeah, absolutely great today, Dan. If you guys are still watching, feel free to hit the like button, subscribe to the channel. If you have any additional questions for the team at IREN, leave them in the comment section below. We'll be sure to pass those along. Appreciate the time today. There's so much excitement going on with this story. I remember, Anthony, you saying you first initiated coverage on IREN at 0.5 exahash, and to look where you've built this business, your brother and yourself, Dan, now is truly impressive. So thank you for the time. We look forward to our next discussion, and we'll talk soon.